Good morning, all of you. Today we can discuss about a topic, derivatives. The term derivatives is firstly originated in mathematics. In mathematics, derivative means it refers to a variable that derived from the another variable. In business, actually it refers to instruments. These instruments are mainly used for risk covering in a business. That is the main purpose of the derivatives. We know mainly there are two types of risk, mainly risk in business or other in commercial field. Main type of risk is the systematic risk and unsystematic risk. Systematic risk is that refers to unavoidable risk. The main example of a systematic risk is natural calamities, theft, and these are the simple example of a systematic risk. Unsystematic risk is the interest rate risk, some business risk, market risk. These are the examples of a unsystematic risk. The derivative instruments are mainly used for covering this type of unsystematic risk in a business. In derivatives are mainly used for hedging the risk. The main purpose of the derivative is the transferring the risk. In derivatives, it refers to a value that derived from the underlying assets. The underlying assets may include interest rate, foreign exchange, currency rate. These are included in underlying assets. In firstly, this type of derivative contracts firstly used in a agricultural sector. In agriculture sector, there are many types of risk. Main risk is the price risk. So farmers are firstly used in this type of instruments for covering the such type of risk. Next, we can discuss about the different characteristics of a derivatives. The main first characteristic is that it is an underlying asset. Derivative because the value is derived from the other assets in derivative. So, underlying assets, it includes foreign exchange, interest rate, etc. And the second characteristic is the no independent value. Derivative because derivative instruments are derived from the other assets. So, this type of, so the derivatives have no independent value. The value is derived from the other assets. And the third characteristic is the predefined period. The derivative instruments are mainly for some specific period, mainly actually 3 months. Is mainly this type of contract is usually entered for some specific period. And the fourth type is the contract fulfillment. The contract fulfilled in future, not a present time. It is mainly settled in a future time. And fifth one is these instruments are mainly for hedging the risk. The main purpose is the risk management or risk covering. And the sixth one is minimal initial investment. This type of derivatives, we need not to involve a huge investment. Only an initial investment is only required for this type of derivative contract. And the seventh one is it is the off-balance sheet item. The derivative contract are not included in a balance sheet. These are the mainly treated as off-balance sheet item. And the last one is it is the secondary market instruments. We know the market is mainly a money market and a secondary market. This type of contract is comes under a secondary market. And the main controller of the derivative market is SEBI, Securities and Exchange Board of India. The full operations of SEBI comes under, the full operations of derivatives comes under main SEBI. The SEBI is the ultimate controller of the capital secondary market. And next we can discuss about the main different types of classification of derivatives. There are mainly derivatives are classified mainly on 3 bases. The first basis is on the basis of payoff, and the second one is on the basis of underlying assets, and the third one is on the basis of trading mechanism. That is the basic classification of derivatives. And first we can discuss about on the basis of nature of payoff. In that system, mainly there are 4 types of derivatives. The first main type is the forwards. That is the first derivative product, forwards. These type of derivative instruments are mainly used in agriculture, mainly used by the farmers. The farmers, that is mainly for price risk, mainly for covering the price risk. Forwards is actually is an agreement to buy or sell a specific asset at a future date. But in forward type forwards, there is some huge risk is involved, because there is no intermediary in this type of forward contract. These type of contract is entered in between the traders. There is no stock exchanges involved. So this type of derivative forward derivative contract is a high risk element is involved. And the second type of derivative contract types of derivatives, the futures. Futures is meaning is same as the forward. Is an agreement to buy or sell asset at some future date. The main difference is the forward and future is the forwards are not organized, not standardized, but futures contract is systematic and standardized, and this futures contract comes under a stock exchange. There is a stock exchange involved in futures contract. And there is risk is reduced in futures contract, but in forward contract there is a high risk involved. That is the main difference between futures and forward contract. And the third type of derivative is the option. Option in contract is an obligation. Option is an obligation to buy or sell some asset or security in some future date. And the fourth type of derivative is the SAP. SAP is entirely different from the above 3 derivative products. SAP simply means is exchange of financial obligations. This type of derivative contract is used by the multinational companies for exchange their financial obligation with regards to their loan repayments. And these are the 4 types of derivative with regard to nature, on the basis of nature of payoff. And next classification of derivative on the basis of underlying assets. In underlying assets, there are 2 types of derivatives comes under. First one is commodity derivatives. In commodity derivatives, the underlying asset is the commodities. The main commodities comes under this type of derivatives are the oil, seeds, petrol, oil products, such type of products comes under the commodity derivatives. And the second one is the financial derivatives. Financial derivatives, the underlying main asset is the interest rate, foreign exchange rate. These are the main underlying assets in a financial derivatives. This is mainly used by this type of derivatives is mainly used by the investors for trading in a stock exchange. And the commodity derivatives are mainly used by the farmers. And these are commodity derivatives are mainly OTC type, over the counter exchange contract, are the commodity derivatives, but financial derivatives are comes under a stock exchange. So these type of contracts mainly used by the investors. And the third classification is on the basis of trading mechanism. Trading mechanism, there are 2 types of derivatives are involved, and first one is OTC derivatives, and the second one is stock exchange traded derivatives. And the first one is OTC. OTC means over the counter exchange derivatives. In this type of derivatives, this type of derivative contract in between the traders, and because there is no stock exchanges involved in this in OTC derivatives. These the main derivative product forwards and SAP is main come under the OTC derivatives. OTC derivatives may used by the farmers and some multinational companies for their purpose of risk covering. The main merits of the OTC derivatives are the first one, it is the flexibility to contract design. That is the main merits of the OTC derivative. And the second one is it is a customized contract. And the third one is the size and nature of the contract. It depends upon the contracting parties. These are the main merits of a OTC contract. And the second type of derivative is the exchange traded derivatives. Exchange traded derivatives is a system, comes under the body of SEBI, Securities and Exchange Board of India. These comes under a secondary market, and these types of contract is organized and standardized contracts. The main derivative products, futures and options, are the exchange traded contracts. The main difference between OTC and exchange traded contracts are in OTC contract there is a high risk involved, but in exchange traded contracts less risk is involved, and there is no transaction cost in exchange traded derivatives, but high transaction cost in the OTC derivative. That is the main difference between the OTC derivatives and the exchange traded derivatives. That is the basic introduction about the derivative topics. Today class is over. We will meet next class. Okay, thank you.